where we put you on the map. This is Ron Costa broadcasting live in the Mappable Studios in Las Vegas, Nevada. And folks, today we're going to revisit a topic that we had on a while back. We're going to talk about some farmland, and to do that, let's bring in Vicki Hutchmala from the World Token Market. Vicki, how are you doing today?
I'm doing excellent, Ron. Like every other day in Vegas, another day, another beautiful day, sun shining. We have a great guest today. We're going to talk about something different in investing and what everybody should have in their portfolio if they don't already, and he's going to tell us why. So I can't wait.
Excellent. Okay. Well, that sounds good to me. Let's bring in David Chen. David is the COO and co-founder, actually, of Farm Together. David, how are you doing today?
Hi, Ron. I'm doing well. Hi, Vicki. Good to be on with you both.
Our pleasure.
Great. Yeah,
David.
nice to have you on. And David, the last time we did a podcast with your company, Farm Together, we had your CEO on, Artem Milanchuk, and he was great. And that podcast really ranked high among our listeners. So we wanted to bring you on again and start talking about what you guys are doing and all these things that are happening over the last couple of months. So it's a little crazy. But before we get going, why don't we go into your background, a little bit about yourself and how you got started in the whole Farm Together industry?
Yeah, absolutely. So funny enough, I guess my background was ironically always in ag. I grew up in upstate New York, surrounded by farms. My first job was on a farm, but never thought that I would be in this industry. My interest was always climate and meteorology. So I studied meteorology in college and ultimately thought that it would be interesting to see how different industries are going to respond to climate change and weather risk. And so I went into finance, worked at an investment bank in New York for a couple of years, then helped start a company called Grow Intelligence, an ag data company based in New York and Nairobi, Kenya, before going to business school. And it was in business school where I started to realize connecting my experience in investing with my interest in climate and ag, it all sort of made sense for farmland investing. And so I had a chance to intern with Prudential's Farmland Investment Office out in San Francisco and Fresno, California, investing across the West Coast in different permanent planting properties. And then after business school, I worked for an agricultural asset manager called Amera Capital. While I was at Amera, I was able to connect with Artem. He was actually presenting at a CB Insights conference in New York. And I wanted to become a client of Farm Together because I wanted farmland in my portfolio. And the conversation went beyond, potentially becoming a client and obviously went much further. So here I am a little over a year later. It's been good fun. The vision and mission of Farm Together is really to make farmland a much more accessible asset class so that more retail investors can have this great asset class exposure in their investment portfolios. And so we're doing everything we can to make that come to reality.
It's amazing how things work out, isn't it, David? Sometimes you get on the road and it takes you right where you need to go.
It's true. And, it's funny. I still consider myself, early on in my career, but sometimes I'll have college students ask me, how did you plan this all out? And there's never is a plan because, half the companies I worked at didn't exist at the time when I was in college. So you just need to go with the flow and follow your interests.
That's right. Adapt.
What I find interesting about this is that...
Tell us a little...
Go on, Vicki.
Tell us a little bit about Farm Together and how your platform works, and more importantly, why people should invest in farmland.
Absolutely. So the way our platform works today, we are serving the accredited investor community. So there are certain guidelines written by the SEC of who qualifies as an accredited investor. We are actively looking at ways to offer products to non-accredited investors as well. But today We mainly can work with accredited investors in the U.S., and our platform is really meant to be a marketplace and an information center. We're a marketplace because we bring different properties, different deal opportunities onto the platform and try to keep as low of a minimum investment as possible. Generally, our minimum investments are $15,000 in any given deal, which is still, that's obviously a meaningful amount of capital, but previously, if you wanted to have farmland in your portfolio, true direct investment in a farmland property, it's pretty tough to buy a farm for under $1 million, and then of course you have to figure out how to operate it if you are not a seasoned grower. So, I'm sorry, I paused there. Oh, I'll keep going. Sorry, I thought you had a question.
No, just keep on. Yeah.
Sure. So we bring all these opportunities onto the platform, and investors can invest in one deal. We have many investors invest in multiple deals and create a bit of, a portfolio for themselves through several properties and gain diversification benefits, even within the asset class, by having exposure to maybe a hazelnut property in Oregon, a almond property in California, and a row crop property in Illinois. So even within our platform, our clients can enjoy the benefits of having a diversified portfolio by participating in some of our different deals. And we offer new deals on a pretty frequent basis. We're launching a new deal, I would say, at least once a month, if not twice a month, on the platform. Wow. And so far, we've done deals in Oregon in the hazelnut space, California in almonds, walnuts, tangos and mandarins, which are citrus fruit, a row crop property in Illinois that farms corn and soy, and we're actively looking at new commodities as well, and hopefully we'll have some new ones on the platform later this quarter. So it's been really exciting.
So do you invest in existing farmland, or do you also have the ability to start a farm from scratch and invest in just a piece of property and bring it up?
That's a great question. So we try to structure different types of deals that have different risk and yield profiles to cater to a very broad base of clients, each of whom has different risk yield, suitability traits and desires. And so we really try to cater to our full client base. And so for some deals, we will, like our row crop deal, Doris Farm, which is, there's still a little bit of room left. It's in Stevenson County, Illinois. I think that deal will probably close in the next week or so, but that is on the far low end of the risk spectrum for us because it is a row crop property. So the difference between row crops and permanent crops, permanent being anything that has a permanent biological asset that you're going to depend on for cash flow for many years, like an almond tree or a wine grape vine. Those, you depend on that asset. If anything happens to the asset, your cash flow profile is going to be much different and have a big impact on your returns. Versus annual crops like corn and soy, if you have a bad weather year, obviously it's not a good thing, but you just replant the next year, and the odds of 2 very bad weather years in a row is obviously going to be much lower. And then you can also rent out that farmland, which we do, to a tenant. And so the structure of the lease is that you are paid your cash rent from the tenant typically around March 1st of any given calendar year, which is before planting happens, well ahead of before harvest. And so you really have little to no operating risk because you receive your cash rent for that year in March. So whatever happens in planting and whatever happens in harvest, you're pretty much agnostic. So that's the lowest form of risk for a deal. On the other end of the spectrum, I'd say. Oh, go ahead.
Well, I'm sorry. I was just going to ask, do you also consult in your farm investor, the farms that you're investing in? Do you advise and consult them as well, so that if they need to revise, maybe they need to change their crop to something that's more profitable or expand it or whatever, go into cows instead of corn? Do you do stuff like that?
We typically wouldn't, because we'd be making that decision early on. So like if we, going to your original question, if we go for a higher yielding opportunity where, maybe we're taking, like in Oregon, we found a property that was previously growing mint, and we're going to take the mint out and plant young hazelnut trees. That is on the higher yielding side. Those opportunities can yield IRRs well north of 15%. But obviously there's more risk because you are, planting an asset. You have to grow that asset over several years and keep it safe and bring it to maturity. So we would make that decision at the time of acquisition. We would know when we were making an offer on the property that we're not going to continue growing mint on this property. We're going to be growing hazelnut trees. We're going to order this varietal. This is going to be our operating partner. All those decisions would be known. On the row crop side, for rotation purposes, we really defer to the tenant. Tenants operate, thousands of acres of row cropland. They tend to have very large geographic footprints, and they're very savvy when it comes to knowing what makes sense to plant for what given season. So we defer to them, and honestly, the incentives are aligned us, so the tenant will obviously capture all the upside if they have good yield and good price. They have to bear the downside if there's poor yield or poor price. We're just collecting a rent check there. So we leave that decision to the tenant as we think that they know best. Now, the one caveat for that is we do want our tenants in any property to be a good steward of the land, and we do have a sustainability program in place and guidelines around sustainability in our operating agreements that we ask our operating partners to review and consent to. And part of that could involve crop rotation. So if that is in the agreement with the tenant, then of course they would have to abide by that. But that's a bit different than sort of a short-term strategic business decision. We do that because we think it's a long-term strategic value creation driver, because the science has shown that rotating crops is extremely beneficial to the soil.
Oh,
yeah, it sounds like you have a lot of active projects out there, David. How are these projects evaluated?
Each project goes through a rigorous sourcing and diligence process. So our sourcing process starts with looking at big criteria that, I kind of, in many ways, farmland is a form of real estate investing. And so, when you're investing in maybe looking for a house, oftentimes you'll hear advice of look for things that you can't change, like the neighborhood, if you're on the corner or if you're not, just geographic hurdles that can't really be changed. You could always change your siding. You could always change the color of the front door and things like that. Farmland has many of those same aspects. You can't change where the property is located. If it's in an area where there's lots of well-experienced, highly professional operators, where that there's going to be a good operator available to service the property. If the farm is in a water district, particularly in California, that has excellent water rights and has proven to be resilient in times of drought. If the property has class 1 and 2 soils, which are the highest in terms of grade, and so that there's very nutritious soil available on that property. If the property is in an area that's more prone to various weather risks, like perhaps frost, or when we look at climate projections, and we incorporate climate risk in our underwriting. So when we look forward 10, 20, 30 years, do we believe that the property will be more susceptible to some of these weather risks in years 10, 20, 30 than they are today? those are all factors that are very difficult to change. You could always change, the commodity that's grown there, assuming it's in an area that's suitable for a diversified planting. You could always change the operator. Those are easy levers to pull. Very hard to change what water district you're in. It's actually impossible to change what water district you're in. So those are the things we spend a lot of time getting right because they're irreversible. And then once we've winnowed down the list based on those big items, we then look at some of the finer points of the property. We consider proximity to other farm-together properties, and if we're able to leverage an operator that we worked with in the past that we enjoy working with. And so it's a big plus if we're able to extend another property under an operator that we know is proven and does great work. We'll also look at, basically the marketing program in that area, what packers are available, what packers usually service the area, how much success has the local marketing programs had in the past. So we start to take a deeper dive, and then, of course, when you get to true diligence, then you're doing sort of the minutia details. Again, it's very similar to home buying. You have your home inspector come in, and you're looking in the crawl space and really taking a close look at the property. We do the same thing. We'll do water testing, soil testing. We'll do an on-site evaluation. If there are trees that we were buying with the property, we'll evaluate the trees and look for uniformity, overall tree health. It gets much deeper and more minute the further into diligence you go, but our sourcing strategy for each project starts on a very high level where we look at those factors that can't be changed.
So you do so much due diligence ahead of time that your investors, when you finally get to the investor point where you're looking for investors, they can feel relatively assured that what farm they're investing in is likely to succeed and give them a return.
Absolutely. We document our diligence and make it available, and we hold a deal webinar for any offering that we have where we show the results of the diligence process and why we ultimately decided to choose that property. The other thing to keep in mind is, we have the benefit of being able to be extremely selective with which properties we decide to ultimately invest in. We probably see, several hundred, if not even over 1,000 properties for every one that makes it to the platform.
I can understand that.
When a property makes it to the platform, it has been thoroughly vetted, and we make the results of the diligence widely available. I think the other thing that is a trait of ours, which I appreciate, is much of the investment team, actually the entire investment committee, really grew up in an institutional investing environment, and so we were trained by other institutional investment staff and professionals from that space who really prioritize and emphasize having a discipline to be conservative in your underwriting process. And really, the underlying tenet here is that principle of it's always better to underpromise and overdeliver. It can be tempting to be a bit zealous and hope that prices over the horizon end up being in the upper end of the reasonable range, or that production ends up seeing a really good year, in one of these 5 years. But there's no data to suggest that will happen, and so we will not model for any upside outlier events like that. We're very conservative in our underwriting. And thus far to date, all of our distributions have either met or exceeded what we had in underwriting. So we're very proud of that, and that will be I think that will be a characteristic of Farm Together that will go on in perpetuity just because of the makeup of the investment committee.
Sure. Yeah, it's very impressive that you can deliver those kind of returns consistently. That's really nice. But let me understand this correctly, then, David. So your company scours and looks at farms, purchases them, and then brings in the operator to operate them, and the investor invests into the project. Is that right?
Yes. So these could take different flavors, again, based on the yield and risk profile that we're trying to build for the deal. But in any deal, we source the property. Often these are off-market opportunities. We do also look at the on-market opportunities, and we'll, again, depending on the quality of the property, we will look at on-market and potentially pursue on-market opportunities. But generally, these are typically off-market opportunities that pass our filters, get through our diligence process, and so we ultimately invest in the property. And then we will come up with a sources and uses table, or effectively a budget of how much we need to raise, not only to purchase the property, but we like to have a modest reserve account, in case, again, going back to your home, we keep going back to the home example, but if your boiler breaks or, if that's a good one, let's stick with that. If your boiler breaks, you need the reserve account to put a new boiler in. So we like to have a reserve account just in case there is any unexpected expense that we can draw from. If there's a development budget and we're replanting trees, or maybe we're improving irrigation to reduce the amount of water leakage and water waste on the property, we're going to budget for that and account for it at the time that we raise for the property. And then we also consider, the deal structure. So if we're leasing the property out to a tenant, we won't need to budget for operator expenses because the tenant will be covering those and will be compensated with rent. And the investors will receive a distribution that's driven by that rent. But if we are doing a direct operate model where our investors have the upside or downside of yield and price, then we need to identify an operating partner to do the asset management, and we need to account for the asset management charges for them to do the farming and to provide the labor and to provide the equipment. So we'll account for that too. So that's all done at the time of when we raise for a deal. We don't have capital calls. We don't do anything like that. Everything that we believe we're going to need for the project is raised at once at the beginning of the deal.
Well, that's terrific. That's really great. And every project that's listed on your website is your deal. There are no third-party deals up there, right? You guys own those at Farm Together, right?
Yes, those are all of our deals. We for the row crops like Doris Farm, we do work with a partner of ours, a fund called Farmland Opportunity. They are a large fund, I think nearly $500 million in AUM, and they've been managing row crop properties across the U.S. Since 2009 and really have a tremendous track record. So we leverage them for sourcing because they have their boots on the ground and have an ear to the ground as well, and so they help us identify properties on the row crop side. So Doris Farm is an example of a deal that we worked with through Farmland Opportunity to source. However, Farm Together is the investing entity. We end up purchasing the property, managing the property, doing all the fund administration, processing the distributions, all of that, and we are in charge of the sale as well. For all the permanent plantings, which is every other deal on our site, those are all sourced by the Farm Together team, and same thing, they're managed by the Farm Together team. Administration is handled by us. Sale will be handled by us. So those are really end-to-end Farm Together deals.
Yeah, I like the idea of being able to invest in a farm without kind of waking up at 4 o'clock in the morning and go planting yourself. That's really kind of cool. These investors that invest into your projects now, how are they taking ownership of the investment? Is it a share? I mean, are they investing directly into the real estate, or how does that work?
So the way it works, and you guys are going to get so tired of me saying this, but again, it's like real estate. So there are a lot of different crowd-funded real estate companies, many are well known and notable. And it's the exact same structure that those companies use. So we form a separate bankruptcy remote LLC, which serves as a special purpose vehicle or SPV. And this LLC will be in the name of the offering. So we're not super creative with our offering names, at least for the legal entity purpose. We tend to go sequentially. So you'll see our deals are farmed together 194, 195, 196, and so on. So we just closed a hazelnut deal called Brody in Oregon, which is Farm Together 199 LLC. So that is the Farm Together 199 LLC is the ownership entity for that deal. So investors who invest in Brody will receive a proportional interest in that LLC. So if Brody, for simplicity's sake, was $1 million deal, and you both invested $100,000 collectively into the deal, you would own 10%. And so you would own 10% of Farm Together 199 LLC, and you would be entitled to 10% of all distributions from that entity. If there was capitalized expenses, you would receive those as well, 10% of those. And then at the time of sale, you would receive 10% of all the net sale proceeds from Farm Together 199.
It sounds like this would be a good thing for tokenization, don't you think, Ron?
Yeah, a possibility, especially from the liquidity part of it, absolutely. But what else sounds interesting on this too is, David, it sounds like that this could be a 1031 vehicle too for people who are looking at 1031 exchanges. Is that right?
That's correct. So so for our crowd-funded deals on the platform, those are unfortunately not open to 1031s, but we do help many investors on our bespoke side. So our bespoke channel is basically if you wanted to outright own a farmland property, or if you and a couple of investment partners wanted to own a farmland property and not have it shared, more broadly through a crowd-funded mechanism, you could reach out to us and we help clients achieve those goals on the bespoke side. And we've worked with several clients who have sold, in the past year, rental properties, multifamily, commercial real estate properties, and they've been able to leverage the 1031 exchange and exchange their proceeds from the sales of those investment properties into a farmland investment property. So that has been interesting. Many clients don't realize that the definition of like-kind property is so broad, but it does meet the standards. So, we do help clients often who do sell a more traditional real estate investment property and like farmland as an asset class and learn that you can enjoy the 1031 benefits and still gain the diversification benefits of adding farmland to your portfolio. And so they'll take us up on that and work with us through our bespoke channel.
Yeah, and none of us, of course, are accountants or anything, but I understand that there's also something about taking possession with a 1031 in the same manner or the same type of organization somehow, where that gets a little tricky sometimes. But it sounds like that what you're doing now is something that would probably work for them. So that's kind of interesting. I really like that idea too.
So David, has there been any kind of impact on farm investing due to the coronavirus?
There has. It's been very pronounced. So, I think prior to coronavirus, I think it's hard to imagine those times again, but the equity markets were strong and employment was strong, and there really was no, any looming black swan event that anyone was worried about. Of course, we had the trade tensions, which, of course, that was a significant event, but the market had largely priced that in. And so, the pitch to investors for considering relatively lower yields, in farmland, we're looking at net IRRs of typically 7 to 15%. So those are still strong yields, but not maybe the 25% that you're seeing in private equity or, high teens that you might see in, various real estate opportunities. I think folks weren't as focused on diversification and non-correlated returns then coronavirus happened, and I think it really was a clarion call for investors that there is a lot of unknown right now. Macro is very challenging, doesn't necessarily make sense. We'll see bad news come out and the market will go up 5%, and we'll see good news come out and the market goes down 10%. So it certainly felt like a little bit of a roller coaster. And we have many folks who come to us and basically say, look, I'm not looking for a 25% IRR. I just want capital preservation and meaningful income. And this is the asset class for that. We thoroughly believe that farmland is the best asset class for capital preservation. If you look at the data, there's only been a handful of quarters where farmland has seen negative appreciation. And actually, one of those quarters was the first quarter of 2020. But if you can remember how challenging of a quarter that was for other asset classes, farmland's base benchmark, which is the NCREIF Farmland Index that tracks various institutional portfolios across the U.S., I believe for the first quarter of 2020, it lost 0.02%. So it was basically flat.
Yeah.
And it recovered in the second quarter. So it is really, really difficult to imagine a scenario where you lose capital on a real basis if you're working with an experienced institutional farmland investment manager.
Well, and with all of the due diligence that you do before you even put a farm up for investment, it kind of makes investing in farmland a little safer and something that people can feel a little more comfortable as opposed to the markets or into gold or even real estate. It's just because we always have to eat. We always need what the farms are producing, and your due diligence makes a more secure, comfortable investment.
Absolutely. That's right. And the theory, what you mentioned there, Vicki, on we always need to eat. That's really an important message. And even companies across the CPG space after coronavirus are taking a very hard look at their supply chains and thinking about how if they have any control on their supply chain, how can they build more control around their supply chain? There was already a theme of traceability becoming an important concept and an important value to consumers. Now more than ever, I think that's been enhanced by coronavirus, and so there's an even bigger demand from consumers on traceability and knowing where their food is coming from and where it was sourced. So we don't see any of these factors going away. We think they're actually being amplified by COVID-19. And we think, even thinking a bit more broadly and strategically perhaps, but even just as a nation state, the U.S. is in a very interesting time when it comes to farmland. So the average age of a U.S. farmer is now 60. So there are many farmers still working well into their 70s and unfortunately 80s and beyond, although I'd like to think that many of those folks just love what they do, and that's many that I know do.
I'm sure that's why they're still working in their 80s.
But, many are thinking about estate planning and, selling the property. And in previous decades, the simple answer for that was it was going to go to the kids or maybe your neighbor. And today that isn't so simple. A lot of the next generation is not interested or doesn't have the knowledge to actually do the farming. And the same is true for neighbors. And so this is an asset class in the U.S. that's 98% privately owned. And many of these farms have never seen the light of day in terms of public market accessibility because they've been passed down for generations. And the USDA is projecting that 70% of all farmland will trade hands in the next 20 years, which is really an astounding figure. coupled with the fact that we continue to lose farmland on an acreage basis. We've actually lost twice the size of the state of Massachusetts in terms of farmland acreage over the past, I think, 20 years. So it's been significant.
Are you saying that you lost that land to development, to cities or housing or commercial development? That's why there's a loss of farmland?
All the above. All of those are reasons that can explain that decrease in farming acreage. But it's incredibly important strategically for our country to control their food supply. And for the U.S., in many states, agriculture is an incredibly important part of the economy.
Right.
California, which is the I think fifth or sixth largest economy in the world on its own, the GDP they generate from agriculture is not insignificant. It is a very meaningful portion of that state's annual operating income. And to be a meaningful portion of California's annual operating income, you have to generate a lot of operating income. So
no question.
It's
a huge state.
It's a vital sector.
Yep.
When you decide to invest in farmland, do you sometimes or do you consider, if a farm is like a family-owned farm and they need help to modernize it or to bring more technology into it, is this something that you look at, or is this something that your investors invest in, making farms more technology-based operations? Or is that even something that farms are doing yet? Because that might bring the younger generation into farmland if it's more technology-oriented.
Yes, it is certainly something that we are very passionate about. We are building a tech-enabled investment company at Farm Together, so we think it is imperative that we use the most advanced tech on the actual properties themselves. And so we're always testing out new hard tech and soft tech ag tech solutions on our farms. And we love being guinea pigs for new solutions. So if anyone is listening out there that has an ag tech solution, feel free to reach out to us. But in terms of working with families on that, I think one of the more common relationships that we're seeing on how we can help farming families is, a family will be in that situation where they're dealing with an estate planning question and thinking about the next step of ownership. And I joke that a sociologist has to, there has to be a sociology PhD written on this, because I'm convinced there's some weird underlying explanation here. But for whatever reason, I find most farmers in the U.S. have 3 kids. I have no idea why that's the case, but anecdotally,
that's all the time they have.
Anecdotally, I keep running into that over and over and over again. There are 3 kids, and 2 of the kids have no interest in taking over the farm and are really looking for liquidity. They may not even live close. If the farm is in Stevenson County, Illinois, one kid might have moved to Chicago and another to New York, and they're just removed from the property. And then one of the 3 siblings is very connected to the property, wants to own the farm, maybe doesn't have the resources to buy out their 2 siblings, but is staunchly against completely selling the asset. Before crowdfunding was really a form of investment, it would be really tough for a family in this situation to find an alternative. Banks are not going to carve out 2/3 sales, and other, neighbors, unless you have a very nice neighbor, would probably not be interested in a 2/3 sale. But the way our platform works, we could certainly, and we have done this, we can leave a residual minority stake with the original owner of 20 or 33% or, something like that, and syndicate out the remaining interest on our platform. We can provide the 2 siblings who are looking for liquidity with that liquidity. and still allow that one sibling who wants to maintain an ownership in the farm to keep their residual ownership in the farm. So that has been a really unique solution that we've been able to offer farm families. It's been really wonderful to be able to help folks in that scenario, because it is becoming more common. And I think over the next 20 years, as we see this projection by the USDA unfold and we see those 70% of farms actually hit market, we're going to find more and more families who I think will appreciate having a creative capital structure like that.
Yeah, and David, before you mentioned about reaching out to you, how would people do that if they're a farmer or if they're an investor, accredited investor, they're listening to this right now? How would they get a hold of you, and website, or what's the best way?
Well, they can learn more about Farm Together and our different offerings and just about Farmland as an asset class on our website, which is www.farmtogether.com. And I'm always happy if folks want to reach out to me. They can feel free to contact me directly via email. My email is david@farmtogether.com.
Excellent. We'll put that in the show notes. And I'll tell you, Vicki, this is really interesting stuff. I mean, years ago, nobody would consider about this, but now all of a sudden, farmland is I was going to say growing, but that was kind of like a bad pun.
You're right. Well,
yes.
And farmland is one of our greatest natural resources, and we have basically a responsibility to preserve it and to make sure that we can grow enough food and produce enough agricultural products to support our nation and help other nations that need it as well through trade. So this is an important thing that Farm Together is doing in a way that everybody can participate in it and own, like you said, own a part of a farm without having to get up and milk the cows. That's a great concept.
Yes,
right,
it is.
Right, absolutely.
Yeah.
And I think, again, before COVID, we and it's natural because we're lucky that we have access to such a stable food supply, and we can thank our farmers for that. But there really aren't many days where you walk into the grocery store and a shelf is empty. And there were many days in the past couple of months where that's happened. And I think it's really, struck a lot of consumers and investors on, how overlooked of an asset class this is and how important it is.
And not just the farmland, but all the ancillary businesses that are part of the farmland, the truckers and the distributors and the grocery stores and all of the other businesses that touch on that farm. They're all as important as the farm, too, for sustainability.
Yeah, absolutely. I mean, it takes a village to get everything onto those grocery store shelves and keep them in good shape and looking nice and green or preserved or whatever, whatever commodity you're looking at, nice and red if it's a tomato. There's a lot involved in accomplishing that. And most folks are lucky that they don't really have to think about that. But I think over the past couple of months, it's certainly become more pronounced, and we really can't take our food for granted.
No, David, if you have a pistachio farm up there, then I will keep that project in business myself. I'll tell you that, right? I'm a huge fan. Yes. So anyway, listen, yeah, exactly. Boy, the two of them, forget about it. David, listen, thank you so much for being a guest on today's podcast. We really enjoyed it, and it was some great information. I really, really, really appreciate you coming on today.
Thank you both. It was so much fun to be here.
Yep. Yeah. And
our
listen, that third child may be listening. That third child of the farm family. Hey, you never know. But Vicki, thanks a lot for co-hosting this. Yes, thanks for co-hosting. Again, David, thanks for being on the podcast. Everyone out there, you're listening to the Mappable USA podcast at mappableusa.com. If you just scroll down to that homepage, you'll see all our syndication sources. You pick the one you like the best, and you'll never miss another one of our episodes. If you want to be a guest in the show like David was today, there's a guest tab there. Just click on that, fill out the form. We'll see what you can do about getting you on the show. And if you like what you heard today, send us an email, info@mappableiusa.com, or just comment on the page that you're listening to us on right now. I really appreciate that as well. So thank you, everyone, for listening. Thanks for your support. We'll be back at you next week with another Mappable USA podcast. Have a great week, everyone.